path has been nothing but traditional. So why don't you walk me through how you got where you are today and how, that grassroots type of beginnings of your family business sort of shaped your approach to investing?
Yeah, look, my story is I went to University of Western and I graduated with a science degree, and it was a recession at that time when I graduated. This is in the 90s, and my brother Richard had dropped out of U of T, who was a brilliant programmer, and we really didn't have anything. My dad had an idea of, you know, developing some software for his industry. So my brother would code that software and then I would sell it. And that's what happened in the 90s. And really, we just came out of like pretty much nowhere with no money, no financing, no background. And I could sell, my brother could code, and my dad understood the industry. And my mom kind of held it all together, and we just kind of got it going. And if you said you were an entrepreneur in the 90s, it was probably another word for you know, unemployed or jobless or something like that, or you just kind of threw that down. And it seemed very differently today, but back then it was kind of this, you like looked as a like you had horns on your head or something like that. And then, we slowly but surely built up that company and that engineering software company. Then we started Blue Cat in the early 2000s. We built up that company and we had we sold all our companies. We had all these transactions, which went extremely well, but I would say that I'm a kind of a 25-year overnight success. That's probably the best way to aptly put, where we've come from to where we are. And we started a family office in 2017. And then we started investing in other businesses and other entrepreneurs. And it's a very interesting thing, transforming your life from being an entrepreneur where you essentially you you take risk for a living to then running a family office where you're an investor, and you learn very quickly that being a pretty good entrepreneur doesn't mean you're going to be a pretty good investor. They're very, very different things. Good investing is a lot slower, a lot more boring, a lot less sexy than building a company. And it takes a lot of patience, and I don't have much of that. And it is just a slow and steady wins the race in investing. And so you have to have almost like a diametrically opposite personality to be a good investor than you are a good entrepreneur. So I've been learning over the years of how to slow down and get the right people in my family office to help us make the right investments.
So you've taken a value-driven approach to building this foundation, this office. I wonder, besides the obvious, wealth management, wealth preservation, what is your mandate for your family office, and where are you focusing?
So the way I looked at it is I have parents and I have two brothers and we all have children. So there's a new generation of the three of us brothers and there's 10 children. And when you look at it, you wonder, the first thing somebody kind of tells you at a bank once you've sold your company, you've made some money, is there's a saying called shirt sleeves to shirt sleeves in three generations. And that's kind of an old school way of saying that my grandkids will basically become penniless because there is never really a good intergenerational understanding of money and wealth and how to live. And so what I wanted to do is set up a family office that railed against that and created a platform for our like larger extended family to live by. And I tried to make it so um, it didn't counter just on me, meaning that if something ever happened to me, we just can't be at peril, right? We have to be, an organization that can go on. And I wanted to create something that would last the test of time. And so in the coming years, how do we get the next generation involved appropriately? Because if my brother Richard and I were kind of like 9 out of 10 in making money kind of guys, and our kids are a six, then their kids are going to be a 3 out of 10. And then the old adage is correct. Nothing really stays on. And also, I find that the scary thing about having a family office is that, I didn't grow up, for example, having a swimming pool or an elevator in my house or going to a private school or ever flying private. And it is a terrifying idea that my kids think having an elevator in their house is normal, or having a pool is normal. It's not normal. And I'm most worried about how do you create a family office that works intergenerationally where they don't see those things as normal, which is a very hard thing to run from, right? And so you have to create this kind of institution that works and gets them to work in that institution properly and understand risk and money, and that relatively life is quite hard, and getting ahead in life is actually a pretty cold and hard thing. And nothing is given to you. And so I'm the family office was created to fight against this idea that anything is automatic, that any money passing on is just simple, and my children will just, you know, get money and just go on with their day, because I think that would mean that I'm stealing their journey. And that's a terrifying thought, because that's real theft, that's real theft. So there's a lot to consider. So there's two things I wanted to: one, get it away from just pinpointing on me as the money maker. And I wanted to make it so that we democratize the idea that all our children and grandchildren have to work incredibly hard to get somewhere in life, because the world is a hard place.
You come from a private equity sort of background, right? Like that's sort of your thing. Like you and your family, you and your brother and your father started your company from scratch. I read that, it was in the back of, was it a print shop or
Photography studio.
a photography studio? That's right. And it was like you would mail those CD-ROMs out. You'd walk into the mailbox
No, no, no,
and
you're too advanced. We would save software to these discs, and we'd mail the discs from the post office, and you try to get people to put the discs in the disk drive in 1996, because the internet wasn't really fully available, or you couldn't download software in 96 that easily, right? Because you had dial-up modems, 28.8 or 56K. So it was early. But these terrible burdens that were so natural and normal now are unbearable burdens today. And it's funny, because there was a lot of things that you and I do today that will become intolerable burdens in maybe 5 years, right? But we don't see it that way. You and I've known you for a long time. And, when I first met you, going to the store and buying a CD-ROM and putting that in, sorry, buying a CD and putting that in your whatever music player at home and listening to it was the way you did it. Today, that's an intolerable burden, right? But
Mhm,
life goes on, and what was normal at the time becomes intolerable burdens, and that's progress, right?
absolutely. Um, Given your background, I'm just gonna, this is an additional sort of
Sure.
thought. Given your background, what would you say stands out most to you in terms of the, companies that probably come across your desk all the time? What are key things that you has to stand out
Well,
before you actually invest?
I I first of all want to really like the person I'm investing with. I know that sounds a bit flaky, that it's an emotional thing, but I want to feel like they will take direction and they'll listen, and they will have they're coachable and easy to work with. Um, if you could get somebody that's coachable and knows how to pivot a company and make the hard decisions, and they're in a good market, you have to be in a good market, because Warren Buffett talks about this. You could have the best management team in a terrible market and they still won't make any money. And I agree with him wholeheartedly. But if you have a great market, or a good market, or great market, and you have some entrepreneurs that will understand that you have to do the hard things about hard things, then I think we have to start the genesis of something that could be good. Every company pivots. The Facebook becomes Facebook. YouTube was a video dating site in 2003. Like, everything pivots to something great. Apple has had many pivots. Microsoft had so many pivots, right? There was a time when IBM just sold typewriters, right? So in one way, one of the most successful companies to make it over 110 years. So I think that great entrepreneurs know how to pivot, and great entrepreneurs know how to pick a great market and know how to pivot in that market. I never know the outcome of the companies I invest in. What I do know is that the entrepreneurs will go through a hard path, longer and harder, and cost more than they ever think. But if they have the resiliency and they have the grit, they probably will make and have some type of outcome.
I was going to ask you, how do you know how do you get a sense of whether or not they can pivot? How do you know that they're pivotable, that they can actually, be resilient enough to reimagine themselves?
So challenge them. I challenge entrepreneurs in the first meeting I have. I'll poke at something, but I'm also ready to admit that I'm wrong. So I'll make a comment, and if I think I'm wrong after they respond, I'll say, "Okay, that's a good point. Yeah, maybe you're right." But I really push them to see if they are sticking to their idea vehemently without considering mine, or they'll like say, "Oh, that's a good point. We should look into that." Like, I'm trying to see if we can have a conversation and a debate about what they're saying. I mean, I met a company today that had a good idea, and their company name was a pure ripoff. Half of the name was a pure ripoff of a very famous company. And I said to them, like, look, the reason you're not getting sued is that no one knows who you are. But if you became any remotely successful, you're going to be sued on that name in a second. So why use it? What are you doing? Right? And to their credit, their reply to me was, "You think? Okay, yeah, I get what you're saying." Because I said, not only does the name make no sense to what you're trying to do, your purpose, you're just basically living off of somebody else's name, and this is going to go down badly, right? But their response wasn't, "Ugh, Hyatt, you know nothing." They said, "You know what? Yeah, you're right." So like, I was trying to save them hundreds of thousands in legal fees before they're known, and their response was correct. Now, that's an example. If they would have said to me, "No, no, 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 we can rip this name off, don't worry." I'm just like, well, that is the canary in the coal mine, that you just don't know how to make good decisions.
Mhm.
It's not like we can start, a burger chain and call it McDonald's. It's not going to work, right? So I can take my decades of experience and give them some of it in a meeting, and then I try to see if they react to it. And I'm willing to be wrong, by the way, because I often am wrong, but I want to see how they react to my feedback. So I come across, relatively less Canadian and more American on a phone call, a little more, aggressive, which is what I admire about Americans.
Mhm. So what gets them in the room to begin with?
They typically want me to invest or join their advisory board or it's typically an investment in their company.
But what stands out to you to even start that dialogue, to be interested enough to say, you've got something here, but your name has got to go?
So if you spoke to me a year ago, I'd have a different answer for you. I'm going to now tell you what I really do when you send me a deck. I could get 5 decks a day on companies or funds, 10 sometimes. And there's 43 pages, small print, nuances. I can't, I would just spend my entire life reading decks. So I don't do it. I use an AI. I've pre-programmed the AI with everything that I like to see and lenses that I like to see. And I have it rip it apart, go out and get me this information, get me that information, look at the founders, look at this, look at that, lens it, scrape it, change it, and score it. And I find AI so incredibly useful to quickly tell me, within what would take 3 associates a week to give me, in minutes, tell me, should I take a coffee with this company? And it'll say, look, this thing is a 3.5 out of 10. Here's why. And I'm like, no, I don't agree with the AI. I'm going to take this call. But most of the time I agree with the AI. I'm like, yeah, that's true. I'm not going to do it. Like, for example, when you get a deck, how do you might like it, but how do you know there's not 10,000 other companies? Because you're not a venture capitalist, so you don't see 10,000 decks, right? You don't know if that's being shopped around to everybody, right? Like, and then there's 1,000 of these companies, and they're never going to keep their margins because they're just going to get crushed into a no margin business. So I asked the AI to go out and find me, like, how popular this style of company is. Are there any successful companies? you know, uh, and I'm looking for certain signals so that I should know if I should take a coffee. And then what I will tell you is, if you do invest in a company, you have to get ready for 10,000 coffees, because you're going to have 10,000 coffees with that founder over 10 years. You know what I mean? You're going to take a phone call on Sunday night at 8, or you're going to have to do this, or you're going to have this breakfast meeting, or they're going to have a panic because of a patent or a lawsuit, or a guy leaving, or they're getting acquired, or they're trying to do a funding round, or they can't meet payroll. There's always something. There's always some hair on fire, right, going on. So when you invest in private companies, you got to be ready for hair on fire a lot. So you got to strap on for that, right? And then you have to ask yourself the question. And the question that your readers should ask themselves is, are you ready for that kind of brain damage? Are you ready to add, like, let's say you've done really well in your career and you're semi-retired and you just want to get involved in business, but are you ready to get into hair on fire conversations for the next 10 years in this investment? Like, do you want that, or would you rather be in Muskoka for the summer? Because if you want to be in Muskoka, that's fine, but do you want to be bothered on a Sunday evening at 6 p.m.? You have to take a phone call and get away from your family in Muskoka because so-and-so hair on fire. And was
Mhm.
that worth the investment? Right?
Mhm.
So you should really think, I call it a brain damage to outcome ratio. Like, how much brain damage are you willing to take to actually do an investment? Okay, so here's some interesting calculus that your reader should do. Okay. Let's say here's a very simple example. Let's say you could buy a building and you own the building and it rents out all these apartments and you have a super that runs it, and you could make a return every year of, let's say, and I'll pick a number like um 17% a year, okay, somehow. And you own it. There's stress. Your super's going to call you and say, we have to change the air conditioner. We have to change this. Oh, apartment 6B, we got flooded. Da 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 da. Brain damage, brain damage, brain damage. But if you just took the same amount of money and gave it to a fund that buys and runs those buildings, who are never going to phone you, and they're going to hand you 11% a year, but you're never going to take a call, and it's on automatic or 12, like, is the difference between what you're going to get paid on that automated version to what you're going to get paid to own it, does that brain damage pay enough between those two goalposts? So the question you always have to ask yourself about an investment is, am I willing to get involved in the brain damage that this is going to take, right? Because every business is hard. Every business takes rowing in the boat. Every business takes tons of conversations. Every business requires heavy lifting. There is no such thing as a straight path to success, right? So in our family office, we have a whole stacks of capital that just go into what I call, when I sleep, it makes me money. The S&P, when I sleep, makes me money. This fund that I give money to in New York, they do distressed debt. They just make me money. They don't ever hear from me. And you see what I mean? Like, there's a lot of things I do where I get paid and I don't take brain damage. So what that really means is, if you're willing to take brain damage, what do you get paid for that brain damage? Okay, so cash today pays 3-4%. It was peaking at 5% a few years ago, but let's say it's 3-4%. Let's say the S&P, I know it's averaged in the last 10 years about 10%, but let's say the S&P on normal, you up and down, whatever, is 8% a year. So to me, your risk-free kind of capital at a family office should be returning 8% a year, because on average, if you just leave it alone, and a lot of people can't, just leave the S&P 500 alone, you're going to get 8%. So if you want to go into the teens, you want to get into private equity. So you pick really good private equity firms that are, I would suggest, large funds that are very good at this. They should give you about 600 to 800 basis points a year above your illiquidity, above your liquidity of the S&P. So call it 14 to 16% at the end of the day, net to you. That's what you should get paid. If you want to get into the 20s, you have to own the company. I understand that some people think they're going to get that through venture capital and high risk, whatever. But at the end of the day, to really get into the 20s, you have to own the building, you have to own the company. And if you want to get 20 to 30% a year in a big return, you're going to have to accept brain damage. You're going to have to expend hours. You're going to have board meetings. You're going to have to get involved. You're going to have to turn up. You're going to have to fly to different states and countries. You're going to have to row in the boat extremely hard. So the question you have to ask yourself is, where on the kind of brain damage stop do I start? Because if you want to get into being an operating entrepreneur, or even the executive chairman, or involved on a board on a company you own, a good chunk of, you're going to have to you're going to have to take some time out of Muskoka to do it. So I think every family office, every investor needs to sit back and say, what are we really willing to do in an investment? Because for the most part, most people should just buy the S&P and give some really good private equity companies money that return kind of 2 to 3x every 5 years, which is a great return, by the way. And that's it. Set it and forget it. Take your cottage, take your vacations, and you're going to be super happy with your 10-year return. But if you really want to get into that outsized return, you're going to have to row in the boat, and you just have to ask yourself, what are you willing to do for that type of return? So I think it really comes down to, your age, your time, how much chutzpah do you have to do this, right? And I don't think, if people are really honest with themselves, Lauren, I don't think many people are really ready to do what it takes to get into the 20s. And a lot of people say they are, but it's, try taking those phone calls at dinner time 3 nights a week. Your partner's not going to be very happy with that, right?
Mhm. It sounds as though it's more than just the 20 that you get at the end of the day. You have to really believe what that company is selling, what
Yeah.
that service is that it is providing. So how many of those 5 decks a day do you get where you say, I'm invested in this business model? This can really
Oh,
be
we would
changing.
invest. Yeah, I mean, if we got 100 decks, we would consider investing in 5 to 7 decks and actually maybe invest in one. And I could go years without making an investment on that side, because it is very possible that you make an investment and do all those hours for the brain damage to get into the 20s, as we just talked about, and get nothing. It's completely possible, right? Zero is an outcome, right? Zero is not really an outcome on the S&P. Zero is a very unlikely outcome with the top 10 private equity funds in the world, right?
Mhm.
A return of capital is probably the worst case scenario, but we can talk about alignment and how we choose private equity, by the way, but how we see that. But you know, you have to, every time your percentage goes up, as you know, and all your investors know this, your risk goes up, right? So you're not going to get into the 20s, 30s, and 40% return unless you're willing to take that level of risk. So if you're willing to take a 30% upside, you have to be ready to take a 30% loss. You have to put a negative sign on the other side of it, right?
Mhm. Mhm. I want to talk a little bit about AI, just because you mentioned this tool is
Yeah,
helping you
yeah,
weed through all of these decks. And
yeah.
is this something that you see most family offices, most outfits such as yours using, or is this the only way as well that you are integrating AI into your day to day?
I use AI 100 times a day for so many things. I ask, okay, I use AI in a number of ways. Um, if I have a theory or I have an idea that I want to know about, I will literally put my AirPods on. I will talk to ChatGPT and I'll say, hey, I want to have a discussion about, I'll give you an example. I want to have a discussion about quantum computing. Very specifically, I want you to teach me, as if I was a brilliant 10-year-old, how quantum computing works, and specifically how photonics works in quantum computing. Because I want to just ramp up really quickly. So I got a 20-minute walk home, and I'm going to have a conversation, and then I'll stop it and I'll ask questions. So it's so incredible. It's so useful and by the time I'm home, I have a very good understanding at the most rudimentary level about quantum computing, how photonics work. So I think that I use it for education. I use it to look at decks. I use it all the time to find something. I say, oh my gosh, I need to what are the top three dental clinics in my area, and what do they do? Like I can find anything. And so what's interesting is I've started to stop using Google as much. I use Google probably 50% less now, maybe more, right? Which is an interesting thing, because never in my life I would have thought Google would ever have a hard time with people using it,
Mhm.
right?
Mhm.
But what I will tell you is the following, and this is pretty critical for your readers to get. I'm part of something called the Creative Destruction Lab at U of T, and I just came from their AI seminar. Now, just to understand this, like Jeff Hinton came from there. We're talking that the godfather of AI. We've been talking about AI since 2014 and 15, the genesis of this stuff. And the meetings I just had with him are the following. We call it now the Fast Five, and that is not the Fast Five companies. The Fast Five is the following. We are entering the fastest 5 years in human history. And we are going to see an acceleration in the next 5 years of artificial intelligence, which is so profound, it's unrecognizable in the next 5 years. Two things are likely to step out for the first time in our history. Remember, I mean, humans have been around as far back as, we can date ourselves back hundreds of thousands of years, but and millions, depending on how you look at it. But really, the next 5 years, we're going to move further than we've moved in 20,000 years of our past in five. And this is why. Math is moving it very, very quickly. It's still compounding and moving exponentially. And we're going to see two things step out in the next 5 years. One is a type of super intelligence. You could call it artificial general intelligence, like the C3PO, or speaking to a robot and you actually think it's human, passing the Turing test. And also quantum computing should ignite and have an incredible jump that we didn't see coming. And those are going to kind of slam into each other, if you will, because quantum has the ability to move computing power up billions of fold. So we're about to invent a million Einsteins or a million PhDs or a million geniuses inside your machine at your fingertips. And the question is, what are you going to do with that? So you will have access to a million PhDs inside a machine by 2030, which is more powerful than billions of humans in a way, right? And it'll know more than every cardiologist that has ever existed or will ever exist, right? And how do we react to that as humans, and how do we use that material? But what's incredible is that we don't have to wait. By 2030, we'll no longer have to wait for an alien species to turn up from another planet. We've literally invented, our progeny is the AI. We're walking into a world where we've created the alien, right? And it's going to be shockingly different than people think. We are very, very, and it's very hard for people to understand exactly what I'm saying, because and if you want to understand how fast this is moving, I can prove it to you. I can prove it to your readers. What I want you to do is look at a silly meme online called Will Smith eating spaghetti. And if you go to 2023 and ask AI to invent a video of Will Smith eating spaghetti, this thing doesn't even kind of looks like Will Smith, but it looks like an alien. It looks weird. 2024 kind of looked pretty good. A little bit of Will. 2025, it looks, and on something called VO3 by Google, it looks pretty beautiful. Now, what's the interesting thing about that isn't how good the video is getting. It's the differential in the video every year. So the year between 23 and 24 and 24 and 25, it looks to me as just a lay person that it's getting 10 times better a year. And we're very bad at seeing exponential growth in our front. And Ray Kurzweil, the futurist at UFT, at Google makes this point so many times when he talks about the singularity, is that we are very bad at seeing the future because it's exponential. And what looks like crazy stuff today in science fiction and silliness actually will come to roost in 5 years. And the reason for that is math, and the reason for that is compounding and exponential growth, which humans are very bad at seeing. We're very good at taking our linear past and applying it to the future, which should mean we should get to artificial general intelligence by 2080. But if we move exponentially, we're at 2030, and we're just not good at seeing that. And just remember the first time you looked at ChatGPT 3.5, you were like, okay, something is happening very different here. And it was the shocking jump. It was the first shocking jump. But when you get to ChatGPT 6, 7, and 8, it's going to be so profoundly different in the experience. And it's going to be super interesting how we interconnect all that, and how humans use computers as agents to go and do things for us, and help us get things and use collectively all the information available. I'm very optimistic about humanity's future in technology. I'm much more Star Trek than I am Terminator. And I know there's always a lot of stuff that, well, what if AI ends the world and all that? Well, there was a time when we had decided to use fire so we could cook food. I mean, if we decided that fire was dangerous, which it is, but we used it to cook food and we made ourselves today. So it's kind of an example, but I think people are going to be shocked at how fast the needle moves in 5 years. So when you're making investments, one of the smartest investors I saw over the past couple of years was actually Tyler Perry in Hollywood. He was just about to build a soundstage a couple of years ago. He took a look at Dolly, I think, from ChatGPT, and he realized very quickly that if you just move that exponentially, you may not need a soundstage anymore. What he realized was something most people don't. If you would have looked at Dolly or video creation from text 3 years ago, 2 years ago, you probably would have surmised that it's so far away that I can buy the soundstage, build a company, and sell it to Hollywood, and they'll still won't be close. We have moved so fast in 3 years that I'm pretty sure that this will happen. I'm pretty sure by 2030, you will turn on Netflix or whatever it is, and it'll know pictures of you and your family, and you'll choose a show, and it'll put you in the show, or it'll write you the show and show you a 6-part series based on what you wanted to see. And you'll
Hmm.
be the star of the show.
It's
And
very
it'll be in it,
interesting.
right? So when you're thinking about investments, it is extraordinarily difficult right now to make a bet because how fast things are moving. Remember, the guys at Blockbuster weren't stupid. The management team at Blockbuster is actually very smart. What they misunderstood was the rate of change of when movies would be piped to your home. They did know that movies would eventually get piped to your home. They didn't understand the rate of change, right? That's the same thing with no one can see these things coming until they see it coming, right? So, in being an investor today, it's never been cheaper to start a business, but it's never been cheaper to fail, which is good. But at the same time, everything is going to be challenged. I assure you, lawyers are going to be challenged, doctors are going to be challenged, accountants are going to be challenged. I think us as humans are going to want somebody physical sitting next to the machine to explain to me, human to human, because we're still the same genetics for 100,000 years, what the computer is saying about my heart. I'm not sure I'm ready to listen to C3PO about my heart, right? I think I'm willing to listen to the computer, which is probably going to be right. And that computer in the next couple of years is going to three-dimensionally print me a pill to my DNA, to my specific biomarkers. But I'm
Mhm.
going to want a human to describe what's really happening. I think people are going to want that doctor to be a high EQ and not high IQ in the future.
Mhm.
Does that make sense? So I
Mhm.
think that so many jobs are going to get transformed because these advanced super intelligent systems are going to augment how we do things. And we're still going to want humans to be side by side, but it's going to change practically how we look at all these jobs. And it's also going to democratize things. So let me give you an example. Like right now, if someone wants to get into litigation, that's not something people can do if they had a claim because they just don't have the money for it. They don't have the time for it. But if you have supercomputing, you can not only figure out, you can have the robot write a lot of it pretty soon, but it could also just tell you, you may think you have a case here, but you don't. You have a 13% chance of ever getting anywhere because your facts aren't right. So it could also democratize the idea of what you should and shouldn't do in law, what you should and shouldn't do in accounting, what you should and shouldn't do in medicine very quickly for pennies. So we could give people, the average person with no money, the answer in seconds of what they could be doing better, if you will, right? So in that way, you know, humanity gets better, right? Because we're democratizing information that was really kept in a very expensive cabal. Because we've all heard, well, they got great lawyers, right? They have the money, right? Well, what if we start
Mhm.
taking that away and making it so people could have a supercomputer help them. So there's a lot of things that I think are going to come that are going to change the way in which we do things. And that's true about investing. That's true about how we invest in companies. The S&P 500 are going to have companies that rocket and ones that drop out because they didn't make the jump to AI properly, right? Because now's not the time to try AI anymore. You either have it right now or you're going to get left behind. It doesn't matter who you are. It doesn't matter if you're making chemicals or planes or trains or automobiles or Coca-Cola. You have to have had this going by now.
Mhm.
So we're walking into a radically different world right now, and the next 5 years will be the fastest 5 years on record that humanity's ever seen.
It's interesting that you use the analogy that, well, it's not really it's the reality that this is not the time to sort of be starting your journey into AI. You either have it or you are going to be left behind. A lot of institutional pension plans and now institutional places um, are still sort of tentative about it. They are sort of starting that exploration phase. They do have a sense of where it can take them, but they're still sort of tentative about the risks that come with it. You have the benefit of a different lens where you're not managing someone else's per se. It is your family's capital. You take the risk that you think you can handle, whereas a pension plan has thousands of members that they are really there to safeguard their retirement futures. Are you using it, AI, to do things like stock picking or telling you where the market is going to go right now, whether to give you some
Yeah.
historical sort of data on
No, no, because I'm actually shocked at how wrong AI gets it still. So I'll give you an example. Like right now, we're living here's the problem. The stock picking, I think some people have figured out some pretty cool algorithms to make some trades. We don't trade. So our family office doesn't do call options, don't trade, don't short. We don't do any of this stuff. We just buy and walk away saying, look, we trust in the S&P and we're walking away. And sure, we absolutely own Microsoft and Apple and Google and Facebook. Sure we do, like everybody else. At the end of the day, we don't stock pick because we just don't believe that's a way to do it. The second thing is that AI is really smart until it's not. So for example, if the president gets up tomorrow and says, I'm going to put a 50% tariff on China, like he's done or whatever, I mean, there's no AI that's going to pick up on that before it happens. So your investment thesis could go very, very wrong. So we're living in a world right now where the entire way the world traded post World War II is at risk of being completely changed. So my view on this as an investor is that everybody traded through the US for a reason. The US was the gold standard, and every country in the world has been rightfully jealous of how successful the United States has been. Radically successful. It has Wall Street, it has more oil and gas, it has the best arid farmland, it has it has the super aircraft carriers, it has the military, they have the reserve currency. America, for so many, they're the same size as the entire 27 member nations in Europe, right? So America, for what it is incredible, and everybody saw it as the literal gold standard. What's happened though is the new administration has really shaken the way countries could or could not do trade with them. So countries now are cutting a deal with the US, but quickly cutting deals with each other and trying to figure out how this is all going to go work out going forward. And I think that changes the perspective on how global trade is going to happen, what happens to the US dollar, what happens to the safety mechanisms, and I'm actually unsure of it. My bet is that at the end of the day, America will succeed despite this stuff, but you probably have to stay invested in their best companies and just wait it out. Um, and I think that I've never seen so much global angst and worry about trade and what's going to happen between countries that I've seen now. But at the end of the day, I think that this will work itself out. I think the midterms in the US are going to be extremely interesting because it could create probably very much gridlock in the US, which the markets will go up substantially if there's gridlock. And we don't, I couldn't ask, I don't think AI is at the point right now of guessing any better than any human what would happen in trade right now. I mean, if I were to pass a guess what's going to happen and why the S&P, as we're having this conversation, is going up, is that the S&P is the markets are saying, look, I think the tariff thing is going to kind of go away, deals are going to be cut, and by the way, I think that sooner or later, Trump's going to get his nominee into the Fed, and that person is going to be a massive dove. And that guy's going to, I mean, Trump's already said he wants interest rates at 1%, but even if this guy gets it to 2%, I mean, it's going to be dramatic. He's basically telling you to buy stocks. right? When money becomes free, buy stocks, right? Because people are gonna, do a lot of buybacks, and that's what we do. We loan money, they do buybacks, the price goes up, earnings per share goes up. So I think the market is signaling that the US is becoming as dovish as they can in the future. And I think that what I don't know is the unknown unknowns, as Rumsfeld said, right? I don't know. I don't think an AI can aptly pick out, what the macro is going to do, right? I
Mhm.
think AI is probably going to be able to pick up some pretty cool trades, but that's just kind of not our thing. So, sorry for the
Yeah.
rambling, but that's kind of
No, that's
how I see it.
okay. So, you just mentioned you've got Google, you've got Amazon, you got the big Mag Sevens, you just set it and forget it, but we know that even they are having a difficult start to the year. So where are you focusing in terms of that growth?
We try to do three buckets, and we never get to the split that we get to. If you look at our asset allocation, we always try to do a third or more in the stock market, a third in private equity, big P, small VC, as in like we do more in private equity than do in venture. And then our last bucket is that we're always trying to acquire a company and use our operational excellence to do something, right?
Mhm.
Um, and we we don't try to time the markets. We just try to back great entrepreneurs in a great market, and we know that markets will ebb and flow. But anytime we invest in a company, we our our minimum hold time in our head has to be 10 years,
Okay.
right? So we don't do quick trades. We don't do we don't get caught up in, you know uh I love CNBC, but I don't get caught up into this, trade that, buy this, buy that. It's like this constant,
Hmm.
churning wheel. Like it would drive me crazy to do that. I'm not trying to do that. And look, some
Hmm.
people are incredibly successful at it. We're not. I mean, there's something very nice about being a family office and, no matter what happens, making 10% a year. Sometimes we make 30%, but sometimes, but I mean, it's
Hmm.
like it's something that's very nice, just being very predictable.
Well, it seems as though what you've just described as being there to pick up the phone when things go wrong and you have to really talk it through with the CEO of a company that you've
Right.
invested in, that kind of gradual growth can't be done under 10 years, which is a very long-term view that you need to really realize. Go ahead.
Yeah, if you want to make an asymmetrical return, though, you have to do that. I mean,
Mhm.
look, absolutely, some people buy a stock and buy Nvidia or Shopify early, and they get that kind of return. That happens every once in a while. Sure, it does. And then, if we knew what it was going to do, we'd all have piled in earlier. But the truth is that, you know, you have to be there for the ride with the entrepreneur, if you're going to do the private markets. It's not for the faint at heart. I'll say that. It's
Mhm.
it's certainly a tough path.
I mean, I know we just had this long conversation about AI, and a lot of people would say that that's where they're pivoting. That's where they're really looking for growth companies that are doing something different. Where are you seeing private equity? What sectors are you really seeing potential, for that growth in the 5, 10, 15, 20 years
Yeah.
sphere?
So, do you want to actually name funds or?
Sectors, like, is it
I,
just
I so
AI that's
so
intriguing? Is it's
so
sustainability
so
and within that
so
clean tech?
listen. I don't fully understand clean tech, so I stay out of it. I don't quite understand health tech, so I stay out of it. I like we just backed a very large private equity firm's fund who does like a lot of automation. Like they'll be buying into companies that are doing robotics that have a minimum of 50 to 75 million of EBITDA per company. So this is not like startups. We buy into a lot of companies, businesses out of New York that do distressed debt very well, come in and do turnarounds. That has been very successful for us. We do companies that do massive roll-ups. One in Toronto in particular, we back a fund that way. I sold my company to Madison Dearborn, so I stay invested with them because I really like them. Um, but pretty much, I stick to things that I understand. I stick to things that I feel um, that are probably going to do well in the future. And listen, we're not always right, but typically we don't chase fads. So we never chased blockchain, which if we had this conversation 5 years ago, that's all we would talk about. Today, all we talk about is AI, and I feel that there's a lot of good stuff, but there's also equally a lot of bad stuff in that. So AI to me is just a means to an end. And I don't want to hear about AI. What I want to hear about what you're doing for the customer and how you're delighting them. And by the way, you happen to be using AI as part of your story. That's kind of what I want to hear. You know,
That's very interesting. I mean, you're right. Like there's going to be AI winners and AI losers, and
more losers than winners, because whenever the crowd runs after something, you know what happens, right? It's a pretty tough haul when, it's a pretty crowded trade when everybody's in AI. You know, so
Mhm. Yeah.
you know.
I mean, that said, my daughter using it in school, they're making them adopt it within their schoolwork, right? In some
Yeah,
way,
yeah,
and
yeah, yeah.
testing out
Uh,
these platforms way before we were using them in the
So
regularly in
you
the
bring up a
workforce.
really important point. Let me just give everybody a little bit of a piece of advice, and you're probably going to think that I'm nuts for telling you this. If you're in a company right now, you desperately need to go hire 2 students. And you're like, Michael, what are you talking about? What I want a student? They know nothing. I guarantee the student knows more than you. I have now hired 5 or 6 students at one of my companies, and the way they come in using AI is not like we understand it. And I'm hugely appreciative of their intelligence. Like, so for example, I want a new product coded. They use Cursor. They use Devon. They use Pika. They use all these different products, Copilot. They use all this stuff, and they're doing stuff that we wouldn't naturally do. We'd code this. We'd use a little bit of AI. The way they are so naturalized to it, a
Mhm.
20-year-old today, I believe some of those valuable people right now in the workplace are 20-year-olds. I can guarantee it because I've seen it. And I'm hugely appreciative of students. And a lot of these students can't get jobs right now. I'm like, people don't know what they're missing.